Good morning. Morning. We are just about to start our program. Karibuni sana. I hope everybody has had something to bite, some tea, coffee. But before we do that, I would like us to arise for the Kenya National Anthem and the East African National Anthem. Great. We may all have, we may all have our seats. Again, karibuni sana to this morning. Thank you for braving the cold weather. We are about to kick off the program. But before we do that, allow me to introduce myself. My name is Mary Gidenji, Group Head of Marketing and Communications, and also your host for this morning. I will also like to introduce our key stakeholders in the room, starting with our executive leadership. In the room, we have our Group CEO, Mr. Kihara Maina. We have our Kenya CEO, Mr. Gul Khan. Karibu sana. We have our Chief Finance Officer, David Ngata. Karibu sana. We have our COO, Mr. Jamie Loden. Karibu. We also have our Retail and Business Banking Director, Shamir Patel. And we also have our Executive Director, Business Development, Ele Shivram. Apologies for that. We have our Director for Digital Business, Eunice Katama. And then we have our Group Head of Strategy, Rocky Olonde. Karibuni sana. We also like to appreciate the presence of our journalists, our media community, our investor relations community, karibuni sana, as well as my colleagues from INM. Now, as we kick off, we'll have a very tight program. We're not only announcing, positive results, but also our commitment to being on our customer side. And with that, we'd like to start off with our Group CEO, Mr. Kihara Maina, to lead the way. Karibu.
Thank you, Mary. Good morning, everybody. Right, thank you for joining us. I think we were last together perhaps about 6 months ago when we were discussing our full year results for 2024. And we want to be able to discuss today with you what we have been doing since the beginning of the year. So just a recap here of our regional footprint. You will see our presence countries, Kenya, our home market, Uganda, Tanzania, Rwanda, and Mauritius. The network has grown. We now have 110 branches, 150 ATMs, over 850,000 customers, over 3,000 staff, and over 5,000 shareholders. Another, if we could just move it along. Another recap here, and this is, I'm sure you, by now you probably know this just as well as we do. This is the strategy that we are following, our Imara 3.0 strategy, which is running from 2024 to 2026. And to reiterate what our long-term ambition is, which is to be Eastern Africa's leading financial partner for growth, and to highlight the participation choices, which I'll come to in a bit, but also to highlight also where we are investing, which is in brand relevance, group synergies, business resilience, digitization, and cultural transformation. We have been talking at length about the need to do business sustainably, and you will see the 9 SDGs that we are focused on, and we are looking at how we can embed sustainability across our business and the various value chains to positively impact our stakeholders. And to do this, we are leveraging the I&M Foundation. So coming back to this, which is the participation areas, we are in the first pillar looking at how we can develop leadership in our core segments, which is corporate and commercial. And we are looking at building relevance in emerging customer segments. That's the retail and SME space, and to become a leader in ecosystems. So our 2026 aspiration, again to reiterate, we are looking at achieving returns on equity above 20%, looking at getting our customers to be digitally active, and we're looking at digitally active customers at greater than 90%. At satisfied customers, looking to promote us at the net promoter score at 70%, and we have an ambition to hit 1 million customers by the end of 2026. And of course, from our staff side, we're looking at being recognized as the best bank for employee experience. Overall, we're looking to impact 10 million lives positively by the end of 2026. So what have we been doing over the last last 1 year? You'll see that we've impacted over 8.3 million lives, 7.4 million indirectly through our partnerships, but 851,000 customers directly. So you will see customer growth at 34%, which is really commendable in just the space of 1 year. Our NPS is holding up even despite that growth, and digitally active customers have actually ticked up to 86%. These customers that we are acquiring are also bringing in significant revenue and are now contributing 24% of our revenue. And our subsidiary, and when I say subsidiary here, I mean the businesses outside Kenya, contributing 24% to our PBT. Returns on equity are going in the right direction at 16% compared to 14% last year. When we then look at the individual segments, and this is aggregated across the group, you'll see that between ourselves and the business that we are doing cross-border, that's gone up year on year 104% at $4.7 million. We are looking at target growth areas in the oil and gas space, the public sector, the China corridor, and leasing. And these are contributing 10% of corporate and institutional banking segments operating income. So this is the first segment we're looking at here. And when you break down those numbers, you'll see loan book growth at 2% in the CIB space, 12% up on the deposit side, and the contribution coming in from the CIB space to total revenues is total operating income at 31% for the half year. So looking forward to, or looking to the retail and business banking space, we've been making some good strides in getting more relevant in this space, looking at customer-centered product innovation. So I talked about the 34% growth in customer numbers, and we are looking at how we can really improve our access to customers through both physical and digital channels. And you will see the growth in branches at 13 year on year, with ATMs also following at about 9. And the focus areas here within the segment on the asset finance side, we are looking at home loans, giving people shelter solutions, bank assurance, digital lending, and this contributing 22% of this segment's operating income. So On the loan book, similar growth at 2%, which reflects the kind of prudent focus we've been having in this challenging environment for lending. Deposits, again, really just managing margins, and we have seen just a 4% drop in the book there, and the contribution from retail and business banking coming in at 45% and looking at operating income. The ecosystem play that we have been focusing on is really about getting partners that we can work with, and is an important plank of how we look to impact people positively. So I mentioned the 7.4 million lives that we've impacted, most of this through financial inclusion, and this is contributing to 8% of our operating income. This is embedded within the numbers I just shared in the other segments, and we are now seeing over 4 million average monthly digital transactions. So if you look at the total group operating income that it has contributed, that's now at 1.7 billion, and this is through the expansion and deepening of the ecosystem networks that we've been building. Well, in terms of how, when we say impacting these clients, we're also looking at how much we actually disburse in lending to individual clients. Some obviously repeat customers, and this has reached 14 billion shillings when we look at all of the different partnerships we have across the group. And we're working with different ecosystem partners in Kenya with Safaricom, in Uganda with UGEFA, and in Tanzania we're also working with Airtel. So we are really looking at how we can engage our customers a lot better using both physical and digital channels, and looking at service availability at 99%, and the transaction processing at 99%. So this is a summary of what I've just talked about, and you will see the different splits, and a really strong picture in terms of how we are looking at filling out our strategy. So when we say we are investing for growth, the different areas that I talked about where we are investing in our strategy. Digitization is a key plank of that, and we are spending 10% of our investments in technology as part of the total capital expenditure. And this is being then seen in the digitally active customer base at 86%, which is up 4% from the previous period. On the people side, critical plank, we are looking at how we can upskill our people, make sure that we are also paying our people competitively, and this is coming in at 42% of total operating expenses. Our employee engagement scores are holding up at the 78%, very high employee engagement scores. We are proud of the steps we're taking on the sustainability side. In terms of gender diversity, 48% male, 52% female, and also making strides in getting women into senior management at 40%. And this is really on the back of all the commitments we are making on the sustainability side, including what we had captured under our SDGs. On the brand side, 3% of total operating expenses investment in brand. And this has grown, and I'm sure that people are a lot more aware of the I&M brand. So the spontaneous brand awareness score at 34%, up 14%. And I'm sure that you will be seeing a lot more in this space as we grow. Now, we have also been celebrating the I&M Foundation's 5 years of existence. While the activities of the bank in the social investment space have been there for as long as we have been around, we formalized the way we work to really create impact through the I&M Foundation. And we have several pillars that the foundation focuses on. Environmental conservation is one of them. We dedicate about 30% of our spend in this space, and this year we've been looking at how many trees we can partner with others to grow. 600,000 trees grown, and we've committed just about 89 million shillings in tree growing initiatives, which is having the desired impact, working with partners like Kenya Forest Service and the Mount Kenya Wildlife Conservancy. We have also been looking at the education and skills empowerment pillar, and here we've invested 48 million over the past 3 years to expand the key partnership. This is the Enterprise Challenge, working with the King's Trust International and Asante Africa. And this is equipping 1,700 students and growing in 5 different counties with digital, financial, and entrepreneurial skills to enable them really to become future community leaders. We have also been focusing on economic empowerment, which is a third pillar within the foundation. And here, in partnership with the Jonathan Jackson Foundation and the Ma Trust, we've been looking at how we can empower youth and women to really be able to grow their livelihoods. So I will stop at this point. I was going to explain who this is, but I think you all know him. This is Gul Khan, our CEO for I&M Bank Kenya. So once again, thank you for joining us, and I will now hand over to Gul to take us through the Kenya numbers. Thank you.
Kihara is taller than me. I need to put this down. Good morning, everyone. Good to see you all here. Let me begin with our Kenya results. So I'm very pleased to announce we've had a very good first half of the year. Our revenue was up 21%, and our profit before tax has increased 31% year over year. Including our other Kenya subsidiaries, which is Bank Assurance and I&M Capital, where we have a wealth management funds, revenue was up actually 22%, and profit before tax was up 32% year over year. So very pleased with our financial results. Customer deposits were stable, so we're pleased about that. Slight reduction in lending, given the economic environment we're operating in. Very pleasing to see our cost-income ratios come down significantly year over year, and we've had very good positive jaws. Revenues growing much faster than our cost in Kenya. Our cost of risk is largely stable. Our net NPAs have come down significantly and much lower than the industry average that we're seeing from the Central Bank of Kenya data. And also our return on equity as a result has improved significantly. Overall, our customer base in Kenya, you can see we've had massive growth in our customer base over the last 2-3 years, and that's continued to grow. We've had 25% increase in our customer base year over year, increasing from 451,000 to 562,000 customers. And what's pleasing is our customer experience levels have held up very well. Actually, they've gone up. As you can see, our net promoter score is at 81% for this first half of the year. This is even more pleasing given the massive increase in our digital transactions on our platforms. So you can see for Q2 2025, we had nearly 13 million transactions on our platform. First half of 2024, we had 6.6 million transactions. So nearly 100% growth in our transaction volumes year over year. We've continued to invest also in our physical presence in Kenya. You can see we're now up to 24 counties in Kenya, over 64 branches now, and we're continuing to invest in our branch channel and have a nationwide presence. Looking at the segments now, our corporate institutional banking business has been doing really well, continues to grow. We've had strong growth over the last couple of years in our corporate institutional banking revenue. CASA has increased over the last couple of years, as you can see, from 22 billion to 43 billion. Slight dip compared to last year, where we did a lot more of the government-to-government oil LCs. This year, there's more banks who are doing that. On new business initiatives in corporate institutional banking, we're targeting, we're always looking at new initiatives in our corporate business. So now 16% of our corporate institutional banking revenues is coming from new initiatives. These have been, as Kihara alluded to, focusing on oil and gas, leasing, and public sector. And we're very pleased with the results of our corporate institutional banking business. We continue to have a leadership role in trade finance in Kenya. Our market share increased last year to 9.9%, where this is off the Central Bank of Kenya data. We're waiting for this year's results, but our volumes have held up very well this year as well. Thanks. In our retail banking business, which obviously, as you all know, has significantly grown our brand and product relevance in Kenya over the last few years. So our income has grown. You can see our retail banking current accounts, savings accounts, balances have increased significantly. Year over year, we're up 26% in our CASA balances. You've seen the customer growth, like I said. We've had 25% growth in our customer base year over year, largely driven by retail. We also are pleased to see that our lending to the retail segment, the MSME segment, has really increased over the last year, especially. This is being driven by agri-lending, workplace banking lending, and on our investing in our digital channel on our app, where we have our short-term digital loan products. So we've had really good growth in lending to the retail segment. What's also been very pleasing is of this 110,000 customers we've acquired in the last 12 months, a lot of these have come from the MSME segment. So about 30% of our new customer acquisition is coming from MSMEs. You recall we have Nisare Kabisa, which is a free bank to M-Pesa for retail customers. And then last year we extended that to small businesses, sole proprietors. So we've seen a huge spike in small business owners coming to I&M Bank. What's also very pleasing is our wealth management business. You can see our assets under management for I&M Capital have increased massively year over year. We have 70 billion of assets under management. I think we're one of the leading wealth management houses now in Kenya. Our customer base as well has increased significantly for our wealth management business, which is really pleasing to see that we're getting more share of wallet from our customers. Also, in our bank assurance business is also scaling very well. It continues to perform extremely well and is a significant generator of fee income, as well as us meeting our customers' needs for protection products. And again, you can see our customer base has increased significantly in bank assurance. It's up 71% year over year. I also want to end just by highlighting some key accolades we received. First and foremost, our chairman, emeritus, and founder, Mr. S.B.R. Shah, was recognized for a Lifetime Achievement Award this year by the Think Business Awards for his leadership to the banking sector and contribution to Kenya. Also, we've been recognized as the best bank in retail banking, best bank in product marketing, best bank in product innovation. So very pleased to receive this accolade. Also, we were first runner-up for best bank in corporate banking, digital banking, and trade. We've also recognized by Africa Bank Awards this year, again, for our retail banking business. And we also got recognized last month by MasterCard for the number of transaction volumes we do on point-of-sale machines in Kenya. We were recognized as number one. I'll stop there. Thank you.
Thank you. Thank you very much. Yeah, David, karibu.
Good morning, everyone. So to take you through the rest of the subsidiary financial results, maybe I'll start with something that Kihara just showed us, that the subsidiary contribution is 24%, coming down from 26%. So what does that mean? It shows us how balanced our growth has been and how strongly our Kenya performance has been. So you'll see what Google slides did tell us, that Kenya subsidiary profit is growing 31%, But then we are seeing balanced growth across all of our other subsidiaries. And therefore, in as much as Kenya is pacing that fast, we are seeing then the other subsidiaries pushing back to defend their share of their contribution across the group profitability. So Kenya, 31% growth, cost-to-income ratio of 39%, and that is on the back of the significant investments that we are making in our digital capabilities, in our branch capabilities. So we have invested and we are taking that cost on and still being able to deliver an efficiency of 39%. Now, something else that will be overarching is the regional economies. So you will see stable currencies in Kenya, in Uganda, in Tanzania as well. Tanzania, we did have a bit of volatility, but all within single digits. The only country where we are seeing a bit of depreciation, but again single digit, is Rwanda. So you will see that. Then the other thing is where central banks are with their central bank reference rates. They are all, again, in the single digits. I think the highest reference rates we have is in Kenya and in Uganda, which is 9.5%, 9.5% for both countries, following the 25 basis point cut for Kenya. But then we are seeing Tanzania, Rwanda in the region of 5 to 6 percentage points. Then stable inflation. So if you're doing business and if you're looking to invest, I think then there's no good region to invest than the markets we are playing in, East Africa region. And I forgot to mention Mauritius. Mauritius is also displaying similar macros with stable inflation, again about 4 percentage point, CBR in about 5 percentage point, and again relative depreciation of the currency in the single digits. So good region to be doing our business, good region to be invested in, stable macros, which really then support the results I'm going to take you through. So I think I've spoken about the macros for each of the countries, and this investor briefing presentation will be available for you, but to go through, but generally that will be the message for each of those countries. So then I did speak to balanced growth. So maybe we go to the next slide, then we come back. We first show how well growth has been balanced. So Tanzania, group assets, 7% of those assets are in Tanzania. And we are seeing what has happened there. Total assets growing 14%. Then loans growing 11% and deposit growing 9%. So that 7% of total assets that is in Tanzania, if we go to the slide before it, you're seeing it's giving us 5% of our profitability. So yes, Tanzania then weight-wise you can say they are not, they are slightly below their weight in total assets, but that is because some of the subsidiaries where they are in the stage of growth, Kenya and Rwanda, you will see those punching above their weight. So if we go to the profitability, you're seeing then Tanzania contributing 5% of the group profitability. And what is really pleasing for us is to see that operating income growing 40%, profit before tax growing 43% from last year. So right now, for half of the year, Tanzania, we are looking at profit before tax of close to 600 million Kenya shillings. Then, how are we doing this? As we know, Tanzania is one of those countries where they've legislated what the bank's cost-to-income ratio should be. We know a significant number of banks are not meeting that ratio in the market, but it's pleasing for us to see our cost-to-income ratio at 54%. We'd like it to be lower, but the regulatory threshold is 55%. Our cost of risk at 5.8%. Return on equity at close to 13%. And our balance sheet efficiency coming close to about 2 percentage points. Then if we go to the next country, again, Rwanda then, and look at the Rwanda balance sheet. So Rwanda, we have invested, or the group asset the component for Rwanda makes up about 14% of the group total assets. We've seen those assets continuing to grow, total assets 7%, net loans growing 13%, and our deposits growing 8 percentage points. And this growth, I did speak to Rwanda and how their currency has performed. So Rwanda franc has depreciated from the beginning of the year to June about 9 percentage points. So to show translated growth of total assets of 7% against currency depreciation of 9%. So that tells us that in Rwanda franc basis, our balance sheet is growing double digits, about 16 percentage points, 17 percentage point. So we're very pleased about our growth in Rwanda. But then if you go to the slide before that, then we are seeing 14% of total assets. Rwanda is actually outpacing its contribution, 15% contribution to profit before tax. And that is coming on top of, or that is driven by 4% growth in operating income, really controlled cost of risk and the credit quality, and giving us 19% year-on-year growth profit before tax. Again, we have to read this. It's 19%, yes, profit growth, but it's as I'm saying, then Rwanda franc has depreciated by about 9 percentage points. So in local currency, we've grown much, much faster. But then what is making us even more excited? Look at the efficiency improving in Rwanda, now 45%. We closed the year at 51%. This time last year, we were at 48%. So we've continued to see increased efficiency. I did speak to a cost of risk at 1.8 percentage point. Rwanda, Kehara did show us the slides that shows group-wide. We want to be return on equity above 20 percentage point. We are already above that at 22.5. And then a more efficient balance sheet with a return on assets at 3.6 percentage points. Okay. Then now moving on to Uganda. As you know, Uganda is latest addition to the group. So we have repositioned the brand in that country. Now it's I&M. And what we're seeing, the slide in front of you, is then Uganda, we have 7% of the group assets in the Ugandan market. We have seen growth, 19 percentage point for total assets. Customer deposits growing 21 percentage points to close to 31 billion. And net NPL at 2 percentage points. So again, that growth, the total loans that we're showing there of 15 billion, the percentage of non-performing loans is after the provision is only 2 percentage point of those loans. But then Uganda then is the one country where we have to really work that balance sheet, because out of 7% proportion of total assets, we are getting 2% of contribution to profit before tax. So Uganda, big market. We have heard of banking regulation changes. The regulator requires a lot of capital to operate in that country, minimum capital. If you think about the Kenya, we are talking about 10 billion. Uganda have already been there with 120 million of Ugandan shilling as minimum capital for any bank there. So our operating income has grown 3 percentage points, and our profit before tax, we are excited to see that jump from 170 million last year to 210 million this year, a 23% growth. Cost of risk, I did speak to that, but return on equity, return on assets, again, we have work to do to make our balance sheet a lot more efficient and get to where Rwanda is, where Tanzania is, and speak up that momentum, and where Kenya is. Okay. Then moving on to Mauritius. So Mauritius, on a balance sheet basis, very balanced, 4 percentage point. on a profitability basis, 4 percentage point contribution, the slide before that. So Mauritius is a joint venture. It's 50-50 owned, so we fully don't consolidate Mauritius. What we do take is a proportion of our net assets and proportion of our profitability. We are seeing profit before tax. That has grown 25 percentage point from 700 million to 890 million. We are seeing cost to income ratio at 66 percentage point. Cost of risk, it's negative, slightly negative. So meaning that when we run the, when we assess for impairment, we've really not needed to take additional provisioning in Mauritius. Return on equity, 13, close to 13 percentage points. Return on asset, 1 percentage point there. And then on the balance sheet growth, although, as I said, we haven't consolidated this, we're seeing our deposits growing 22 percentage points. We're seeing our total assets growing 21 percentage points to 185 billion. Then, so that gives you the flavor of how we're standing on a country-by-country basis. Then now, diving on to then when we put it all together, how do our results look like? So you're seeing operating profit growing 21 percentage point. As I've articulated, that growth, we are seeing it balanced all across our subsidiary, all across our markets. Profit before provisioning growing 30 percentage points, or 30% from 11.9 to 15.4. And then that has been achieved, profit before tax growing 34% from 8.7 to 11.7, and that has been achieved without losing any prudence. We've continued to make provisions on our loan losses, which has increased 17 percentage points from 3.5 to 4.1. So very deliberate. We are not afraid to take to make the big call. So we've continued to make sure that we are well provided. We are well provided for on our non-performing loans. But then across the group, then what is this showing us? Efficiency. From this time last year, group-wide, our cost-to-income ratio was 48%. We've improved 5 percentage points. That improvement coming through in Kenya, where we've seen our jaws widen, coming through in Rwanda, coming through in Tanzania, coming through in Uganda, as well as Bank One. We've seen our return on equity improving from 14% to 16%. Yes, our goal is to get to 20%, but that is improvement of 2 percentage points during the year. And as I've mentioned, some of the subsidiaries, particularly Rwanda, is already above the 20% minimum threshold that we've set ourselves. But then more exciting is how efficient our balance sheet has been. 60 basis point improvement in our balance sheet. To contextualize that, that is 60 basis point over 230 basis point, 2.3% where we were last year. You're looking at about more than 25% improvement in the balance sheet efficiency. Then moving on to the group balance sheet. So 4 percentage point growth. Yes, we've seen Kenya particularly, our loan book has not expanded. We do know how the Kenya macro environment has been. We are seeing our deposits have expanded, muted growth of 2 percentage point. There's an effect there of translation. But then, and this is important, and especially if you are an analyst in the room, I've spoken a lot about us not being afraid of making the right calls to take on provisions, even as we've delivered these strong results. So if you look there, the graph on the gross NPLs, we're seeing our gross NPLs declining from 12.3 percentage points to 11.8%. That's a 50 basis point improvement. Now you compare that one across where the rest of the banking industry is. We've seen central bank come in and say this time last year or June last year, the industry NPL was 16.1 percentage points. It's increased to 17.4. So that's 130 basis point growth. Ours has declined. And then not only that, The industry, it's at 17%, we are at 11%. So much, much lower. And then the other thing I'd like to highlight then, if you take the trending, if you're an analyst, and I think there are pencils on your table, if you take the trending from 2023 to where we are today, our gross NPL in 2023 was 13.6%. Our net NPL was 6.8%. That means we had 50% coverage. Yeah, we take the same numbers in 2024, this time last year, we had improved that coverage from 50 to 57. We take the same number this year, we've improved again to about 66. So we are very well provided for our NPLs. Okay, and if the analyst, you take this, we are showing there the net NPL at 4.1 percentage points. I believe you compare that with all of the other industry players, you will see we have one of the lowest gross net NPL numbers out there. Okay. Then when it comes to then how our balance sheet is positioned, looking to how agile and well prepared to face the future, we have very good liquidity ratios across all of our markets. We are adequately capitalized across all of our markets. And the next one, we put this there to show, yes, we can tell our story about our strategy, how well we have executed, but how has the market validated us? And I think, as Warren Buffett will tell us, in the long run, the stock market is a weighing scale. And when you see that graph there, you can see when our strategy and our execution is weighted by the market, even though we have had variation in the last 3 months or so on our share price, but when it's weighted over a long period of time, you can observe that the market validates what it is we are doing and the results that we are achieving. So to summarize it, then what would be the 9 numbers I would like you to go away with? One is a 21% growth in our total income, 34% growth in our profit before tax, 36% growth in our profit after tax, net loans increasing by 2%, customer continuing to trust us, increasing deposit of 2 percentage points, prudence in management of our loan book. We are seeing cost of risk increasing by 3 percentage points. So prudency, efficiency, return on assets, return on equity growing by 2.3 percentage points, return on assets growing 60 basis points, and our cost to income ratio efficiency growing from 48% or improving from 48% to 43%. Thank you. I'll stop there.
Great. Thank you so much, David, for that. And I think that deserves a better round of applause, please. 34% growth, profit before tax, 7.4 million lives impacted. That is no mean feat, and it speaks to how we are being on our customer side. Now, we will move on the program to the exciting part for analysts and journalists, where we get to put the leadership team on the hot seat. So if we could get the seats coming up, and as we do that, please, I hope you've been preparing your questions for our leadership team. And I would also like to recognize our Global Markets Director in the room, Henry, as well as our Company Secretary, Stella Gasharia. So let us get those seats, and then we can get the questions going. Mr. Kihara Gul, are we ready? So we will kick off with the questions in the room, and then we will have some questions from our online audience. Mr. Kiara, go. David. Karibuni. So we've listened to the numbers. Now over to the questions in the room, and the mics will be passing around. And we shall start with my friend from Trading Bill. I can see your hand. Mr. Minor, a mic over there, please. Go ahead. Is it working?
Yes, now it's working. I think we just need to
Perfect.
First of all, I would like to really appreciate the leadership of INM Group for such a stellar numbers. I think we have not seen this in this team, and I think my colleagues can attest to these percentages. This is amazing and well done. I have 13 questions, but I'll ask one.
Oh, wow.
But this is in a positive note. I'm just curious to know about your loan growth. I think you talked about 2%. And why I'm curious is because we have seen interest rates really go down, and you would expect there should be a net effect of excitement from the customers to really take up some of the products that you offer, and especially on the loan books. And I'm curious to know why such a small number has been seen. Knowing very well as well, when I look at your retail participation, it is one of the most tremendous when we see that. What would you attribute to that? And maybe just on a hook note as well, I would want to hear from your end how your conversations are going, since now you have been talking with your regulator, a lot to do with how you relate with your customers and loans and all that. Please just paint a picture on that. That should be my question.
Thank you. I'll talk to Kenya here. So what we've seen, you're absolutely right, interest rates have come down. It's terrific, and I think the government and the central bank has done a great job in bringing it down in Kenya. Obviously last year rates were very high. So we've seen in the banking sector last year, assets were basically flat, customer loans were basically flat. Interest rates came down quickly beginning this year. What we've seen and what we've learned is, especially for large corporates, the time it takes to move from, let's say, not investing, not doing a lot of capex, and then making that decision and us dispersing loans, there's time there, right? So what we're seeing is we actually have a very good pipeline now for lending to large corporates and to large SMEs. It just takes time, right? So I think what you'll see in the second half of this year, definitely by Q4, you will see lending to large corporates in Kenya pick up. I'm sure that what we're seeing from the other banks is very similar to what our story is at INM Kenya. Lending is still largely subdued. The other side is retail. Our retail lending is really shot up, right? So that is growing significantly because of the investment we've made in our digital lending products, especially for MSMEs. A lot more MSMEs are coming to INM Bank, and we're lending much more to them digitally. Again, on our workplace banking, retail lending to individuals, we've seen huge growth. So overall numbers don't show that growth, but at a segment level, we are seeing, retail lending kicks in much faster. The large corporates, it takes time, right? Especially when you're perfecting security. So I would say just give it a little bit more time. You'll see lending pick up in Kenya for sure.
Thank you, Gul, for that. Mr. Kiara, the group question.
Yes, so I think the picture that Gul has painted is similar. However, you'll recall from David's numbers that you had different performance across different markets. While yes, you have seen 2% overall group growth in the loan book, you have to take into context that you're also seeing repayments actually happening off the customer loan books, and what's in the pipeline actually getting onto the books. So net, it's 2%, but actually the growth is obviously significantly higher. If you also consider that in other markets, you're dealing with currency depreciation, so you saw the numbers in Rwanda in particular, where you've seen the strongest amount of growth in the loan book, it shows you that, yes, we are actually continuing to invest in our customers. They're interested in borrowing, but the headwinds have been strong over the past year or so, and you need to appreciate that customers are also looking and saying, okay, is it time yet to get back into investing and so on.
All right. A follow-up question? Yeah, go ahead.
I wanted you to also talk to me on what you've been talking with the regulator, because I keep hearing them say you're discussing.
Gul, I think that one's for you.
So I think a couple of things which are important. One is the fact that, again, with the monetary policy in Kenya, interest rates have come down significantly, and the macros are actually very good right now, you know, at a macro level, which is great to see. And interest rates have come down, and the central bank has done a really good job there. There's been discussions, as you know, then obviously about risk-based pricing, right? And the central bank has come up with a new position, and we're just now in the process of implementing it. We welcome that. So the discussions that we've had with the central bank via the Kenya Bankers Association, we welcome the discussions, and we are very happy with the position that, you know, the Central Bank of Kenya has now taken on pricing. So I think we're in a very good state from an industry with the Central Bank of Kenya, and I think for Kenya's economy, Kenyan business people, Kenyan consumers, what the government and the central bank has currently done over the last few months is very positive. We just need a bit more time to see that come through into long run.
Right, thank you. Any more questions? There we go.
Hi, my name is Mark Otani from Swalanyeti. There's the big talk around AI and how it's impacting business. I'm just wondering, going into the next phase of AI, how is I&M, like every other sector, how is I&M adapting to what AI brings, and how are you going to apply it in loans, cybersecurity, staffing? How is it going to impact your business in the long term?
Gul, you can take that.
Thank you. For sure, the discussions around AI have just increased significantly, right, for all of us. You just can't ignore it right now. We're already using AI. I can share that with you. So for that digital lending products, we are already using AI. That's been for over a year and a half now. So we've seen great success with that. The use cases are just increasing, right, for everyone, whether it comes to, you know, how we're managing our customers, how we're doing our processing, operations. You know, remember historically, bank operations, you would have like a checker, a maker and a checker, you know. Now you've got, you know, robots, and you've got agentic AI. So all of us will be investing in, will have to. I think it's still a bit of us finding our feet, to be honest. Right? We're much more keen to invest in the customer-facing side of AI, right? So I think the industry as a whole is here now. We're all going to be investing in this space, and I think it's going to be very positive. But I think we just need a bit of time. You know, banks tend to be a bit cautious with new technologies, so we just need to obviously make sure we're doing it the right way, making sure our customer data is secure, privacy, but it's taking up a lot more management time for sure.
Thank you for that.
All right, thank you. Excellent performance. This is from a shareholder perspective. David, so I've always struggled with the statutory loan loss reserve to banks, KCB and I&M, because of late I&M has had a larger percentage of SLLR as part of the shareholder funds. So obviously I compare against all of the banks, listed banks, and what is driving that? Yes, I mean, yes, the theory that, you know, CBK wants more, blah, blah, blah. But why is it that I&M has this consistently high versus, you know, I can pick any other bank. I'm just giving example. You and I can always meet and I can show you all the numbers. So what's driving that? Also in the annual report, you know, for this year, throw in extra notes in there. And I love reading the small print. So unfortunately, it's just shown up, you know, statutory loan loss reserve, these are the numbers, but there's no, shall I say, color to it, okay? So that's the first question. The other one, probably for Gul or for you. for Kenya, that is, what is the split between shillings and FX on the balance sheet for loans and deposits? Because that of course may drive some of the pricing of the assets as it happened. Now, the other and the final question, or maybe not, but now that the branches have started maturing, what started about 2 years ago, two-ish, I remember. What are you finding is the break-even time frame for these branches? And I want to say thank you, Gul, for making the branch I use expand that branch. Thank you so much. I appreciate it. Squeaky wheels do get greased. So now, finally, AUM and INM capital has shown a huge growth. So are you seeing a shift from your FDs to AUM, to INM capital? Are you seeing a significant shift? And a lot of people I know, MMFs have really grown huge if you look at Sanlam and everybody else, right? And I believe INM is managed by Sanlam, right? So how, as a bank, are you looking to manage that? Because at the end of the day, you want to lend that money out. And so even if they lend it, even if Sanlam invests back in INM, nevertheless, there are all these question of margins, what do you get, and all that. How are you managing that, or how do you think you might manage it? Thank you.
Thank you. I'll start with the last question first on INM Capital and the significant, massive growth we've had in assets under management there, which is brilliant. I think, look, first and foremost, you have to be customer-centric, right? Let customers choose whether they keep the money in bank deposits or in wealth funds, and that's I'm comfortable with that position. Our job is to obviously offer the right products and services. On a positive, obviously, what we've seen is that our deposit base has been basically stable, right? So obviously it'd be more concerning if money was moving from bank deposits into non-bank deposits, but our overall deposits have declined. So I think it's just a positive story. It's great that we're having more discussions with our customers about financial planning, right? It's an area which is really important. And we hope over the next year or so we actually democratize much more this financial planning space, right? So a lot more everyday Kenyans can also have the ability to, save regularly in money market funds. So I think actually it's a good story, right? Our deposit base has been stable, and we've grown this fee income line, and our customers are having more investment vehicles. On the branches, so yes, on an overall basis, the branches we've opened, about 25 branches in the last couple of years, they're performing much better than their business plans, right? And the overall level, majority of them are. Second, we're seeing, OPEX break even of about 18 months, 12 to 18 months, which again I'm very happy with. And we're continuing to invest. Hopefully we'll open 9 more branches by the end of this year. So we'll get up to about 75 branches, and we still aspire to have 100 branches in Kenya in the near term. On the mix of foreign currency and Kenya shilling, we've obviously seen, lending in dollars has come down, and obviously the deposit mix has changed. Last year, let's say Q1 last year, when the currency was under a lot more pressure, there was a lot more dollarization of deposits, right? That has obviously changed because the currency is much more stable. So we've seen that change in mix. I'm sure David can give you the exact numbers if you want on that. David, anything?
Okay. Thank you. So maybe just continue on that one. On the FX, especially for Kenya, our balance sheet is about 40% FX, 60% Kenya shilling, and nothing when you compare or you get those numbers from our peers. I think almost everybody is somewhere between 35. So on the question of the statutory reserve, very good presentation. I think on my slide, I tried to do that lastly. How the statutory reserve the main thing is what type of customers are we lending to? On our corporate side, we are very well secured. From an IFRS perspective, when you're making the provisions, we have to take in When are we expecting cash flows from those collaterals? If the cash flows are coming from the collaterals, then we discount those. However, when it comes to the central bank, then they're saying every year you have to write off 20% of your collateral. Now, in relative, and I think maybe the way to understand our statutory reserve, I would like you to maybe think about it from an element of prudence. It's only 10%. If you're looking at Kenya, it's only 10% of our total shareholders' equity. Again, similar number group-wide. But then, and you can do this exercise, or I'm happy to do it and share it, is if you take all of the banks, in our publications, the financials that we all put in the newspapers, we will show you what our gross loans are, what our suspended interest is, what our provisions is, and what is our net NPL. And for us, if you look at our net NPL, let me talk about the group numbers, but it's the same thing for Kenya. Our net NPL today is about 11 billion. Our statutory reserve is about 9.7 billion. So what are we telling you? From a capital position, we've actually more or less taken 100% reservation on our net NPLs. You compare us with any of the other banks that have a low number of the statutory reserves, and if they were to do what we have done, they would be losing 10%. No, they'll be losing about, some of them will be losing about 50% of their core capital. So for us, it's only 10% of our capital, and we've reserved it, from a statutory perspective. For the other banks, it's 50% of their core capital, and there's no reserve for it. So it's an element of prudency. And just to take you through then, I did speak to the net loan number. We'd have one of the lowest. If you convert that number to coverage, I think our coverage is 66%. I was going through the stats of the various banks that have published. I think the highest has 73% coverage. We do have some that are in the lower 50s. So we are very well adequately provided. We take that risk seriously. And on top of it, we have the prudence to make sure that whatever is not coming through IFRS, then it's more or less fully provided from a statutory basis. Hopefully that answers that question.
I think we'll do. That makes more sense when you get numbers in front of us.
Yes. Okay, thank you.
Okay, thank you. Kiara, anything to add there?
No.
Okay. All right. Any more questions? I see a question there from Jimmy.
Can we just check if people online can hear?
Yeah.
I'm hearing that there's some issues with people online not hearing clearly.
All good? Okay, great. We're about to come on to the online questions as well. Jimmy, go ahead.
Good morning, everyone. Jimmy Mbogo from Citizen TV. I have a couple of questions. One of them is, of course, speaking for shareholders. I'm sure what they would want to know is what are they getting after this half and after such impressive results. The second one is what are your concerns going into the second half of the year? And looking at what is happening within the region, within the Kenyan economy, what are you most concerned about? Now, the other question around that is we see in the industry, particularly with your colleagues, some of their subsidiaries are contributing about 50% of their earnings or close to that. I just want to know with I&M, where you and when do you see your subsidiaries contributing more than, let's say, half of your earnings? And lastly, is looking at your NPL numbers. I just want to know what sectors are you concerned about and which ones are pushing those NPL numbers.
Okay, we can start off with a group question.
Right. So I think the question on contribution needs to, and I think David put it very eloquently when he was talking through the numbers. Kenya is racing ahead. It's growing phenomenally, right? And to see the other countries hold their own means they're also growing quite strongly. What's the long-term ambition? We certainly would like to see at least 50% contribution coming in from outside Kenya, right? But that is not at the expense of Kenya, for example, growing. We expect Kenya is going to continue growing at pace. What we want to see is that our out-of-country subsidiaries are also growing strongly. Now, if you look at our positioning in the various markets, Kenya is just about 7th ranked in the market, sixth, I think now, and with an ambition to be 5 by 2026. We are still relatively small in our other subsidiary markets other than in Rwanda. Rwanda, we are the 4th largest. In Uganda, we have just under 2% market share. In Tanzania, same thing. Rwanda is about 11%. So you can see that there is a lot of ground to make up. Now we have significantly large opportunities in both Uganda and in Tanzania. And as we continue to build out our businesses there, we expect that contribution to rise. We are also not closing the door on other markets, right? We said our aspiration is to be Eastern Africa's leading financial partner for growth. What that means is that there are opportunities for us, similar to what other Kenya outbound banks have seen, that then present us with an opportunity to also provide a big counterpoint, like you have seen in these other groups, to Kenya. So that remains something that we keep on watching. In the meantime, organic growth is really what's going to do it for us. And we are happy with the contribution that's coming from the other countries at the moment.
Okay. Thank you, Kihara. And I think before I pass it to Gul, there's a question here online just tied to Rwanda. Justin Mwangi, is the low cost to income ratio in Rwanda largely due to the size of the country? Asking as regional subs usually have struggled with a higher cost to income relative to Kenya.
So we saw that Rwanda's cost to income ratio has come down actually to 45% from 48% before. Now, you do have to put Rwanda in context. Rwanda is actually the oldest bank in Rwanda, right? It's even older than the central bank in Rwanda. So it's had an opportunity to mature over time. Now, the build-out that you're seeing in costs over time has come from the investments that we've been making in platforms and in expansion into other segments that we talked about, building relevance in emerging segments, retail and business banking. We were significantly focused on the corporate side. When you're doing corporate banking, not much that you have to do to get a footprint that's going to serve those customers. You just need really good coverage teams, and you do have to make the investments in technology. However, if you start expanding into the MSME space, into the personal space, you must build out branch networks, you must build out teams, and that comes with investment. That's been happening over the past few years. These are starting to now get sweated, and you're seeing the revenue growth that's coming from those investments, as well as the optimization then of the cost base, now bringing those, ticking that point down. So it's nothing to do with size. It's more about the business and the efficiencies that you're then deriving.
Thank you, Kihara. Over to you, Gul.
You'll have to remind me again. What was the point? What was about concerns or challenges for the second half of the year?
Yeah.
Honestly, first of all, don't actually have that many concerns. We are just seeing hyper growth, right? I'm sure with our customer base, we're the fastest growing bank in Kenya, and that's been there for a couple of years. So we've seen this phenomenal growth in our customer base and obviously our digital transactions. And whoever lives in Kenya can see this brand is, alive, and I would say the brand health is extremely positive where we are right now. I think looking ahead to the end of the year, a couple of things really come to mind. One is, like I said, we do have a really good pipeline of lending to larger corporates in Kenya. If that didn't come to fruition, I would be then a bit concerned, because obviously we do want to be lending more to the private sector. Yeah, it's a better thing for banks to do, to be lending to private sector than just the government. Second, and more broadly speaking, there is obviously quite a lot of fraud right now in Kenya. We're seeing, not just in Kenya, but I think across Africa. So just, making sure around cybersecurity, we always have to tighten up various things, and then, there's probably a bit of an industry of fraudsters out there. So that's obviously keeps me awake sometimes, just looking ahead. So we need to be extra vigilant on cybersecurity and fraud.
Yes, and I think, yes, Kenya does reflect broadly the challenges that we see across the region. It's great that we're seeing currency stability, for example, with the shilling where it is, but not quite the same in all the other countries. David did talk about some of the challenges that we are seeing currency-wise in some markets. And that's a concern. We want to see that the macros are actually balancing out. You've got to look at the trends in inflation, look at the trends in the currency, look at trends in interest rates. And some of these are also going to be impacted by the phase in which countries are finding themselves in the political cycle. You've got elections coming up in Uganda next year. You've got elections in Tanzania this year. And all of this tend to have an impact on certainty when it comes to doing business. So all of this do give us some concerns. We're watching those indicators closely. In the meantime, the focus is really on customers.
All right, thank you.
Yes, there's a question around dividend for shareholders and NPLs.
Okay. Yes. So what he's really asking is whether there's going to be an interim dividend, right? I know last year we had, I think it was in Q3, we announced an interim dividend. So with these half-year results, no, we have not made any decisions on dividends. However, the input is certainly coming in from different shareholder circles, and what we will, as the group board, look at is what that means and make a decision and announce it at the appropriate time.
All right.
Yeah, and then on the NPL question, on the dividend question as well, maybe the only thing I can add is one of the things maybe as management team we have to do is have disciplined capital planning. So we will listen to all of that, but the best thing that we can do for you as a shareholder is really look after your investment in the best way possible. On the NPL, a significant chunk of our NPL is manufacturing and real estate, but we have seen that coming down. I think those two sectors combined, we've seen them improving about 5 percentage point to about mid-40 right now to where.
David, well, you still have the mic. Some questions coming through online. We'll get more from the room. So, cost of risk, what drove the increase year on year and how do we intend to mitigate it? Then question around what proportion of your loan book is RBP versus T-bill market linked?
Okay, so cost of risk, I did speak to being disciplined and making the right calls even when the need to provide is there. So two things I would probably say, especially in the Kenyan market, our strategy has evolved. So we are more into the retail space. The retail underwriting is different from the corporate underwriting. So we've seen as a retail loan portfolio picks up, then the cost, the non-performing aspect on the non-performing loans from that segment would need to provide and think about provisioning for that differently. But the main thing on the cost of risk is what I did speak to, where is our gross NPL, in as much as we've continued to evolve into different segments, our gross NPL group-wide and also in Kenya has barely moved, 34 billion. This year versus last year, similarly 34 billion, and our net NPL gross NPL improving from 12.3 to 11.8. The second question.
What proportion of the loan book is RBP versus T-bill market linked?
Versus T-bill market linked?
Yes.
So maybe we don't really price off the T-bill in our book, right? I think Gul talked to the discussion with the central bank about risk-based pricing, and we've been very clear that it's driven by our cost base That might be influenced by other indicators like the treasury bills and the interbank market, and those are the kind of discussions around what structure we should put to our pricing that we're looking at. But if you're talking about how much of our, well, I guess this was risk-based pricing
Yes.
linked, right? So I guess that's the answer. We don't look at the T-bill as a pricing indicator, and in fact, the discussions with the central bank are really not to look at that as the base.
Thank you. Some more questions in the room? Okay. Mike on this side. As we get that going, there's also another question here from Justin Mwangi. What is the G2G market share now versus 2024? Go.
I don't have the exact data, but basically what we've seen is that more banks have obviously got into this space. So the oil importing companies have more choice. So when this whole program started, there was less banks participating in this, and we were one of the first banks to take a bold stance and get into this space. Historically, we were not there, so we got a large chunk of it. But now it's obviously with the exchange rate being very stable, whatever concerns banks had there are no longer there. So I'm sure our market share has gone down in the G2G oil importing space, but we're very happy with the exposure that we have and the clients that we have in this space. And it's actually good for the companies actually that there's more banks participating in it. It keeps us all on our toes.
Yeah, thank you. Thank you for that. Go ahead.
Shadrach from Pagamon Investment Banker. My question goes to looking at your return on equity is quite low. And could this be attributed to you had issued last year 86 million shares to the market, or rather through a strategic partnership? Could that be an impact to that, or what was the impact of that in terms of dilution to your EPS? Then maybe how did it appear, considering how the rates have been moving, how the CBR has been coming down consistently? How has your rate, maybe all actual or maybe the base lending rate, how has it been looking like? And then maybe this one is for a future, maybe you can look at how to incorporate it. Can we have specifics maybe on that NPL? Can we have a specific, maybe the retail has this NPL, we have the corporate has this, and also maybe specific sectors? Thank you.
Okay, David.
Okay, so on the return on equity, I think what we actually did have is improving return on equity. That went up 2.3 percentage points from 14 to 16%. And yes, you're right. We did take on about 5 billion of additional share capital around December. But then I did speak to the question of the disciplined capital management. We didn't do that to dilute the existing shareholders. We raised that capital because strategically we can see opportunities to be able to deploy it, either in supporting our regional subsidiaries where we are seeing growth, or even opportunities in Kenya. So I don't have the specific numbers. If we hadn't raised that capital, what would return on equity would have been? But it haven't been dilutive, where we have actually increased our return on equity, and it doesn't have any. It would have very negligible. No, actually, it would have an accretive effect because there are some opportunities we've been able to capitalize on. For instance, in our Tanzania subsidiary, we've been able to support that business much better because of that capital infusion that we received. Thanks.
Okay.
Yes, and what David has said is the decision to expand the capital base was also informed by opportunities we were seeing in both Kenya and the regional markets. That capital has been deployed in capital bases in Tanzania and in Uganda. And in terms of the value that it is creating, it is actually value accretive. So it's not subdued the returns on equity. So we're happy with the returns that we've seen, even though, of course, the ambition is to get to the 20%. You asked a second question on I think the last one was a comment about how we should perhaps position some of the NPL information on the various books, and we will take that into account.
Okay, great. Gul, there's one more question online for you. Juma Fred says, Kenya is generally becoming a Kadogo economy. Now, I'll need to explain this one. So, like small ticket items, so really for the Mwananchi, what plans does INM have to cater for this Kadogo person with a trolley boda? Is this niche for the bank?
I think it's actually great that the last mile economy is so big in not just Kenya, but East Africa. I think the challenge for the bank, the relevance is there. We've had a massive growth. Right, like I said, overall customer base has shot up so much, but last 12 months, 30% of new customers coming to INM Bank are MSMEs. Right, small sole proprietors, really that last mile economy. And it's fair to say, historically, these small businesses probably wouldn't have considered INM Bank. But they're considering us now. Why? Because we've got very relevant products for them. Right? We're not charging for bank to M-Pesa. These small businesses do a lot of transactions to their suppliers, to their to partners, buying inventory on M-Pesa. So they're saving a lot of money with INM Bank. That money they're saving, they can use to purchase more inventory, right? They can use to recruit somebody. And then second on our small ticket lending, like we said, we launched our digital short-term loan products. UNISA Group had a digital businesses here. That product's done really well. We're lending close to 600-700 million shillings a month now, just in the 30-day loan product. And again, a lot of the people who are taking this product are small businesses, right? So I think the challenge is for us as banks, how do we need to get more relevant for small businesses, because the last mile economy is not going anywhere, right? And mobile money has done very well in this space. They've driven the financial inclusion in the last mile economy across sub-Saharan Africa. And I think, all of us as bankers need to challenge ourselves much harder. How do we become more relevant? But I think we're on the right path. We're seeing very good results in this space.
Absolutely. Thank you, Gul. I don't want to leave out anybody in the room before we get the last words from our leadership. Okay, great. So, last comments, David?
So, firstly, is to thank all of you for being with us this morning. We are committed to continue executing on the strategy. We are committed to continue delivering strong results, and excited about the results that we've shared with you this morning, and the opportunities that we see in the near future that we should exploit. Thank you.
Thank you, David. Gul?
Just final word, I'd just like to thank our customers for trusting us and continuing to trust us. It means a huge amount to us, especially when we've had this huge growth in customers and transaction volumes. Also, lastly, I just to thank my team. I have a fantastic team, and they've done a super job in serving our customers and growing this brand. Thank you.
Thank you. Kihara?
Well, let me start by thanking all of you in the room and online for joining us as we announced our results for the half year. It's a good set of results, and now that's done. We are going to focus now on the next half and what we can do to sustain that performance. That's going to come from the partnerships that we have with our customers. We say that we want to be the leading financial partner for growth for all of our stakeholders. And a major part of that, of course, is our customers. We do not take you for granted. We listen to you. We want to make sure that we are responding to the asks that you have of us. But a key stakeholder, of course, is our staff, and Gul has talked about his team, the leadership team across I&M. We've got 3,000 staff plus working at I&M, And all of them are working every day to make a difference to all of the customers that we serve, all of the different stakeholders that we have. And I want to really thank them especially for all of the hard work they've done in the first half of the year and all of the work they're doing to protect our customers and continue to innovate for them. And to thank all our other stakeholders. We obviously are part of a community. We're doing a lot of good work at the I&M Foundation, which is celebrating, as I said, 5 years. We're looking to do even more. The more business we do, we set aside 2% of our profits before tax in Kenya to fund the I&M Foundation. Help us make more money, we will actually have even more impact. So let me thank you all for attending today.
Great. Thank you so much. A hand of applause. And there we have it, ladies and gentlemen. We've come to the end of our briefing this morning. Thank you so much for taking the time to join us and for staying. All this because we are on our customer side. Asanteni sana and have a good day ahead.